Hello students, this is Professor Faiz Raut from Jain College of Engineering, Department of MBA. I'm teaching subject Legal and Business Environment. I'm in module 6. In this lecture, I'm going to talk about monetary policies. In the beginning of this module, I have discussed regarding the fiscal policy and the taxation policies of India. In the fiscal policy, I have told you the policy decisions which is made by the government, which relates to the money management in the economy, consist of the fiscal policies, and the taxation which the government collects, which is the revenue for the government, and how it utilizes that money and how the taxation happens. We have discussed regarding that. In this lecture, I'm going to talk about the monetary policy, the policy decisions regarding money which is being taken by the central bank of any country. In our case, it will be the Reserve Bank of India. So in let's move on to the monetary policy. The policy employing central bank's control of the supply of money as an instrument of achieving the objectives of general economic policies. Okay, that means central bank will have control over supply of money. If central bank feels that there is immense supply of money in the economy, in the market, then it will try to pump out the money from the market. And if it feels that the money supply in the market or in the economy is very less, they will pump in the money in the economy. Okay, and how they will do that, we are going to discuss it, and why they do that. There are certain objectives for that. For objectives like economic growth, employment promotion, economic stability, and price stability of the price level. First three objectives are very similar to the fiscal policy objectives, and then the final objective, stability of the price level, it is the central bank or the Reserve Bank of India try to manage money in order to help the or avoid the higher inflation rate and a lower deflation rate. So to flatten the economic curve, the monetary policies keeps on changing. Okay, so how these monetary policies are being changed? What are the instruments or what are the measures which the Central Bank of India, the Reserve Bank of India takes? First is bank rate. Bank rate is the rate which the RBI sets, and the other banks follow that rate. And this rate has been calculated is been used to calculate the interest rate for various kinds of loan by various kinds of banks. So if RBI increases this rate, okay, that means the individual bank will also increase their rate of interest. A rate of interest for home loan, rate of interest for the car loan, for education, from property loan, for business loan, for any kind of loan, uh, depending upon the increase in the rate by the RBI, the individual bank increase their interest rate. So why they increase the interest rate, or why they increase the bank rate, in order to make the loan unattractive. If there is higher interest rate, people will not go for taking loans. They will postpone their plans. So if there is a lot of money supply in the economy, and so to curb the money supply, to restrict the money supply further, RBI increases the bank rate, so that people will not take loan much, and the money supply in the economy will slightly be lesser. Okay, slightly decrease. If suppose the other way around, if RBI feels that there is very less money supply in the economy, the business is not doing good, the economy is slowing down, then in that case RBI will decrease the bank rate, and eventually the individual bank will decrease the rate of interest for various kinds of loan, and people will take loan, and the money supply in the economy will increase. So depending upon the bank rate, the RBI controls the supply of money in and out of the economy. Okay, this is one of the way. Second is cash reserve ratio, and this is a very important term, cash reserve ratio. If you are studying banking, you need to know this terminology, cash reserve ratio, or CRR. CRR is a ratio of the entire money with the bank, which is to be kept with the RBI. Okay, for example, if bank receives 100 crores of rupees from the depositors, so now bank has 100 crores of deposits. Bank has 100 crore rupees. From that 100 crore rupees, certain percentage of money will be simply kept with RBI. Okay, for as of today, the CRR is somewhere around 3 to 3.5%. Okay, we'll take it 3%. So suppose from 100 crores, 3 crores will be kept with RBI from this bank. that ratio, the 3%, that ratio is called as the cash reserve ratio. So individual bank is keeping some amount with the RBI as their reserves. So in case of any difficulties with the bank or anything which is happening with this bank, and if RBI want to take control, or so in that all cases, the cash reserve ratio will be utilized by the RBI. It is the reserve which the individual bank doesn't have any say. So when the RBI wants to increase the supply of money in the economy, they will reduce the cash reserve ratio to maybe 2%, so that the bank will not have to keep 3 crores from that 100 crores. They'll only have to keep 2 crores. Okay, so the supply of money with the bank will increase, so they can give more loans. Okay, just an example. And if suppose the RBI wants to decrease money supply into the economy, they can increase the cash reserve ratios to maybe 4 or 5%. So in that case, bank have to keep more money with the RBI, and bank cannot give much loans. Okay, so using this CRR ratio, the RBI can control the supply of money to the bank or out of the bank. So similarly, third one is statutory liquidity ratio, or SLR. Even this is very similar to CRR, but in this case, out of those 100 crores, there will be certain percentage of money which the bank needs to invest in some securities. It can be government securities, or RBI. RBI will suggest some securities to the banks in order to invest there. Okay, so bank cannot give that money as loan, that money for loan as well. So they have to invest in certain securities. So this is somewhere around 22 to 23% as of now. So in totality, if a bank is having 100 crores of deposits, 3 crores it has to keep to give to the RBI, and maybe remaining 22% they have to invest in some securities. So out of those 100 crores, 25% will be kept aside for CRR and SLR requirements, and remaining 75 crores can be used by the bank for doing its business, for giving loans, and okay, so any kind of activities can be done only with the 75% of the money. So this was about statutory liquidity ratio. Next is open market operations. Open market operations was in India. It is very well developed now, but as of maybe 15-20 years back, this open market operations didn't had any market. So what is this open market operation? It refers to the sale and purchase of government securities and treasury bills by the central bank of the country. Now, there are some treasury bills, or T bills, which they are called. This T bills or government securities are being floated in the market, are being brought into the market. They are some kind of a bond. Okay, bonds, corporate bonds you have. So there are government. They can be called as a government bonds. So these bonds are brought into the market, and it has been offered to the public, and public buys this bond and give money to the government, and government can utilize this money for any type of projects, highway projects, or any bridge, construction of bridges or railway lines, or any of that sort of business. Government can use that money, and the money which has been pumped out of the economy can be used by the government, but the supply of money in the market has been reduced by this. Okay, if the supply of money in the economy is very less, and government feels that we should pump money in the economy, they can buy those bonds from the market and give money to the people, so that people will make use of that money. Okay, so supply of money in the economy can be done by buying the bonds back from the public. Supply of money can be decreased from the economy by giving the bonds to the public and taking money from the public. So using this, we can control the supply of money from the market. Okay, and this selling and buying of these bonds, of these government securities, treasury bills, is generally handled by RBI. So it is one of the way in which you can control the money supply in the economy and out of the economy. Okay, so this was the fourth one. Fifth one is regarding the repo rate. Okay, repo rate also, okay, there are two rates actually, repo rate and reverse repo rate. Okay, repo rate is the rate at which the RBI lends money to the bank, and reverse repo rate is the rate at which the bank lends money to the RBI. Okay, and why they do that? Suppose there is a bank, maybe syndicate bank. Okay, syndicate bank is having some deposits. Okay, they have kept the CRR and SLR with the RBI, and from that 75% they are doing a business. And suppose they have given too much of loans and they don't have money, much money for the depositors to pay, and they are feeling depositors are coming often and they are withdrawing their money, and they fear that they will not have money if more depositors come tomorrow or maybe day after tomorrow. So in that case, they will borrow money from other syndicate banks, which is their head office or somewhere. Now there is no money at all left with all the branches. Then what they can do, they can go to other banks as well. Okay, for example Federal Bank, for borrowing money. Suppose Federal Bank also doesn't have any money, so they will finally go to RBI for to borrow money. They are not taking any money from CRR or SLR, they are borrowing money from RBI. So for that borrowing rate, which the syndicate bank will go to RBI, the borrowing rate will be the rate which is called as a repo rate. Okay, repurchase options. The repo stands for repurchase options. So the rate at which, the interest rate at which the RBI will lend money to the syndicate bank will be called as the repo rate. And suppose in the other way around, RBI wants some money and they are short of money. So in that case, RBI will ask some of the bank which are cash rich. They can ask money from the bank as well. So the bank will RBI will borrow money from the bank, and that interest rate of borrowing is called as a reverse repo rate. Okay, reverse repurchase options. So there is a no free transfer of money from the bank or from the RBI as well. There is a rate of interest. So from when money flows from RBI to bank, the interest rate is called as a repo rate. When money flows from bank to RBI, the interest rate is called as a reverse repo rate. So RBI can increase this reverse repo rate, RBI can decrease this reverse repo rate or repo rate, whatever it is. So RBI can increase and decrease depending upon how they want the supply of money into the bank. Okay, so this is the crux of these 5 points. Well, again I'll go through what bank rate was very what do you say, very high in the mid 80s, mid 90s. But after 90s, when the inflation started declining with the rise of growth of the economy, mainly due to economic reforms in 1991, as a result RBI started reducing bank rate from 97 and continued till 2008. And this bank rate was raised to 7.5% in July 2008 due to the global economic crisis, because inflation was going high. So when inflation starts increasing, RBI will increase the bank rate so that it will make the loans very unattractive. Okay, and reverse will also be true. Cash reserve ratio, I have told you. Okay, it is another traditional monetary tool with the RBI to control inflation. Similarly with SLR, statutory liquidity ratio. And open market operations, I have told you, it is the purchase and sale of government securities or the treasury bills by the central bank of the country. So RBI will purchase or sell the government securities in the open market in order to increase or decrease the supply of money. And the reverse repo rate and the repo rate. Okay, they will these are the rate of interest which the RBI will lend money, and the commercial bank will lend money to the RBI. So these are the some of the monetary measures. Going with the next one, which is the statutory liquidity ratio or the requirement, SLR. This is this is a proportion of the total deposits which is commercial bank are required to maintain with them in a form of liquid assets, cash reserve, gold or government bonds. Okay, the commercial bank will be told to invest the certain amount with them, which they have received through deposits, to any government securities or in gold, or maybe kept as a cash reserve with themselves as well. They cannot use those money for giving out loans. So this was about SLR. It is a special provision in India. In many countries, in many major countries, this SLR requirement is not there. Okay, CRR is very common in most of the countries in the world. Okay, now after all this, we'll come to Reserve Bank of India. Okay, the main central bank of India. Well, if I go with the history, Reserve Bank of India was established or formed in 1935, and there was a Banking Regulation Act passed in 1930. Banking Regulation Act passed in 1949. And this Reserve Bank of India was initially called as the Imperial Bank of India, and later on it was called as a Reserve Bank of India. But the main powers of Reserve Bank of India were been achieved during 1960s and 70s, when the nationalization of the bank happened. Many of the private banks became nationalized, and they came under SBI, or and many what do you say, banking reforms were done. So the Reserve Bank of India slowly got its power, which is now it is enjoying these powers. And many almost all the banks, you what do you say, almost all the bank listen to the Reserve Bank of India's decisions. Now, why this was important is, why these regulations were important: in order to generate, maintain, and promote confidence and trust of the people in the banking system. Okay, long time back, the banking system didn't had much confidence in the minds of the people. They used to keep the reserves as gold or in cash in their house itself. If you remember, in the old movies, there will be something called as a locker, or a tijori karke kuch, there was a term. So they used to keep money, or save their assets and their golds or the cash reserves in their house, so to build the confidence, so that they keep money in the bank also. This regulations were being done. Next is to protect investors' interest by timely disclosure by the institution and access to information by the investors. Okay, so whenever investors are accessing some information, the depositors are accessing some information, and to protect their interest, to protect their money, this regulations were carried out. And third is to ensure that financial markets are both fair and efficient. Okay, fourth is to ensure that participants measure up to rules of the marketplace. So basically, the banking system should run smooth. People should have trust in banking system. These regulations were being carried out. And there are some functions which of RBI. Okay, using these are the important functions, or the sole functions of the RBI, which I have listed. First is, it is the sole currency authority. Okay, so uh, any kind of printing of notes, or using any printing of, what do you say, the coination, printing of coins, 1 rupee coin, 2 rupee coins, 5 rupee coin, and printing of notes, their counterfeiting measures, using some technology, in order that the counterfeiting, the duplicate notes should not be brought in the economy. So the clean note policy, okay, disposal of the old notes, and bringing new notes in the market, and computerized operations, and many of these decisions, or the work related to the currency, is being done by the RBI itself. Okay, and the major printing the takes place of this money takes place in the region of Nagpur, and also in some parts of Delhi. Okay, the printing of notes. Okay. Second is banker to the governments. Okay. Suppose this is quite important. Now there are some governments which are very rich. Okay, because there are many industries in those state governments. In those states, and because of that, the tax collection by that government is very high. So there are few state governments which are rich, but there are few state governments which are not so rich. So when the state governments are in need of money, they go to RBI for borrowing money. And for that matter, if central government also needs money, they borrow money from RBI. So if the government is in need of any money for the for budget or for preparing some or infrastructure projects or any projects, government is in need of money, they can borrow money from RBI. Okay, they are okay. Keep in mind they are borrowing money because the money doesn't belong to government; it belongs to the central bank. So that's the reason why there are two policies which I have told you: fiscal and monetary policies. So this come under monetary policy. So the government borrows money from RBI, same on the interest rate. Some interest rate they'll be using for borrowing the money, and RBI will lend money to the government. And third is bankers bank and lender of last resort. Okay, this I have explained it, but I have not used this term. Suppose the syndicate bank wanted money, so they first went to other branches of syndicate bank, then there was no money, then they called other banks as well, like Federal Bank, Kotak Bank, there was no money. So finally this syndicate bank went to RBI for to borrow money. So it is the lender of the last resort. Okay, आखिर में after asking everyone there was no money, so finally we went to RBI. Finally syndicate bank went to RBI for money. So RBI acted as a lender to provide loan to the syndicate bank using some repo rate. So RBI acted as a lender of the last resort, or the bank for the banks. Okay, it was a bank for the syndicate bank, so it is called as a bankers bank as well. Okay, last is controller of money and credit. Okay, these what do you say, the monetary policies which I have told you, how they control the inflation, how they control the money supply to the bank, outside the bank, how they control the money supply in the economy, out of the economy, how they do that, and the credit. I have told you there are a few. What do you say? There are two types for it. They control it. The first is quantitative credit controls. So quantitative may these all will come. What do you say? Cash reserve ratio, statutory liquidity, and moral suasions. That means, and RBI will RBI will instruct banks so that they will be restricting some of the supply to some of the clients because there is a case against them or something like that. So moral suasions will come under picture. So by this measures, quantitative credit control can be done by RBI, and selective credit control can be done by putting some ceiling or minimum margins for lending against securities, or some interest rate will be prescribed for giving of agricultural loans, some interest rate will be provided for giving business loans. Different kind of interest rates can be done for the credit as well. So these are the roles, some of the roles of the RBI.